QuickBooks Pro Plus Desktop 2022 OneNote presentation. Write checks for expenses and prepaid assets. Let's get into it with Intuit's QuickBooks Pro Plus Desktop 2022. If you have access to OneNote, would like to follow along, icon left-hand side, topic introduction 7220, write checks and expenses and prepaid assets tab. Also take a look at the immersive reader tool, topic introductions in the text area too, same name, same number, but with transcripts. Transcripts that can be translated into multiple languages, either listened to or read in them. Same name and number as presentations as well. Topic introductions designed to give an introduction to the topic, provide screenshots, links where applicable, give accounting background to complement the presentations, and can be used to follow along with them if you don't have access to the software at that time. Closing the icon on the left-hand side, we're starting out with the screenshot. We're going to be entering checks for normal kind of month-end types of bills. We'll be using the check form in order to do it. Next month, we'll use the bill form to enter the bills and then pay them, but we're on more of a cash basis system this time with the write checks form. The typical scenario will be with regards to the accounts impacted, checking account going down, the other side typically going to some type of expense unless it's some kind of prepaid assets like insurance typically, in which case we'll have an asset account which will be prepaid assets. We will start off with that scenario being we're paying for insurance. Now insurance is the one that's a little bit strange because by definition, unlike a telephone expense or utilities expense, you pay for insurance before you get the coverage of the actual insurance. So if you're paying insurance month by month, you might still just expense it to an expense account for insurance expense. However, most of the time you might end up in a situation where you're paying for like 6 months of insurance or a quarter of insurance or a full year's worth of insurance, in which case you might want to put it on the books as an asset at the point in time that you pay for the insurance and then plan for an adjusting entry at the end of the month or year. That's typically how an accrual accounting system would work. If you do not do that, what will happen is that when you do a comparison between like January and February, if you paid for a year's worth of insurance in January, you got the benefit of it in February, but you got the expense of it all in January. It looks like January is a lot worse off than February on the income statement, when that's not really the case. Performance-wise, you might have done similar performance, but you just expensed a huge amount because you paid the cash in January. So typically we'll put this into a prepaid account. This same kind of concept can apply to any other thing where you're prepaying, you're paying before you get the goods or services. So if we then scroll down, we're going to be adding the prepaid insurance. Instead of an expense account, it's going to be an other current asset type of account. So here is our check, decrease in the checking account, other side going to the prepaid expense. Even though it says expenses here, this is not an expense account. It should really just say accounts here as opposed to items, which also track other things like inventory items, but it doesn't. It says expenses, but it's not an expense. It's an asset because it's going into prepaid insurance, which is an asset. If we record that out, then we're going to see the checking account will go down. The other side is going to go into the prepaid asset of prepaid insurance, which we don't see here because we're too far down on the trial balance. But let's go to the next one. We're going to write another check here, which is going to be going to Staples. We're going to say this is for office supplies. Decrease in the checking account, other side then going to the expense account, this time of office supplies. Noting that supplies in general is something that you might have the same situation of putting it on the books basically as an asset and then expensing it as you consume them in a similar way as you would with inventory, or you might just expense it as you purchase them, which would be more of a cash basis system. Oftentimes that will depend on how large the supplies you have. So if you have like medical supplies, for example, then you're probably going to put them on the books as an asset, count them, have a physical count as you would in a similar way to inventory. If it's small things, you're buying staples and whatnot, even if you're buying a year's worth of staples, you'll probably just expense them because they're smaller dollar amount typically. So we're just going to expense those items here. So on the trial balance, we're going to have a decrease to the checking account, the other side going to office supplies down here. And then if we see the income statement, we've got the office supplies has been included. Notice what we don't have is the insurance expense because we put them on the books as an asset. We will record the expense when we do the adjusting entries, applying the expense for the portion of the insurance that we have used for the portion of the insurance time frame that has passed. Next, we've got the utilities. It's going to be Edison is who we are paying. It's going to go to an expense account again, noting that if it's an electric bill, you could choose to just put it into electric expense, but oftentimes we still group the utilities together, which is going to be electric and gas. And that could differ if you have a type of business that uses a lot of gas versus electric or something like that, where they become more relevant. You want to break them out, as has happened for most businesses with regards to the telephone, which also used to at one time kind of be in the electric or the utilities type of area. So notice this is a general rule. It's not put down in stone. It's really going to be what's best for your particular business as to what type of groupings you want to put together. So this would decrease the cash. Other side down here in the utilities expense. Utilities expense, noting that that's something that you get billed after you actually consume the electric, and therefore it would be expense typically when you get the bill. In this case, we're paying the bill at the same time we get it. Here it is on the income statement. We got the utilities and the office supplies. Now we're going to go to Verizon. This is the telephone company for us. This is the vendor. The other side is going to be on the expense side for the telephone expense. Once again, you could put this into utilities. At one time, they kind of did oftentimes, but the telephone has become so important that oftentimes it's going to be broken out into its own category of telephone expense. So this will decrease the checking account, other side going into the telephone expense. As we can see the telephone expense side of things down here. Here's the income statement. We got the 3 expense accounts for our bills. If we go into the vendor information, now we got the Verizon here, which is our phone company that we are paying in the vendor center. And then we have the insurance company that we paid and Edison up top, so you can track the payments that have been made in that fashion. You can also go to the transactions detail and look at the checks information and look at the checks that have been written that way. You can also go in the check register if you so choose. Look at the checks there. If we look at this with regards to debits and credits, then the first one when we paid the insurance would be a debit to prepaid insurance instead of insurance expense credit to the checking account. So notice we don't have an expense down here for that. Instead, we increase the prepaid insurance in a similar way as you might be used to. It's the same kind of concept as like property, plant, and equipment, like a building or equipment, where we put it on the books as an asset and then expense it over time as we consume it. Same kind of idea here. We're putting it on the books as an asset because we haven't yet consumed it, and then we will expense them when we consume them, as we consume them. And the checking account goes down. We look at the GL accounts. We could see that in the checking account, it was at $123,100, down by $12,000 to $111,100, and the prepaid insurance goes up to $12,000. Then if the next one was the office supplies, which is fairly straightforward, which is going to debit the expense, the credit's going to go to the checking. So now the checking account has been impacted by those 2 transactions. The other side going to the office supplies, increasing down here. That's going to have an impact on the income statement, whereas the last transaction did not because we put it on the books as a prepaid. And so this makes the net income $14,815, the sum of the $46,877, the $5,180, and the $37,242. And then it goes down by the $500 to the $14,315. Checking account was at the $111,100, down by $500 to the $11600. Office supplies up by that $500. Next, we have the utilities. So the utilities adds to the checking account going down. Other side down here on the expense area. And once again, it has an impact on net income. Checking account was at $110,600, down by $620 to $109,980. And the utilities is going up to the $620. Next, we're going to go to the telephone. Same kind of concept. So they debit the telephone expense. The other side going to the checking account. The checking account being impacted again with a decrease. The other side going to the telephone expense down below with the $500. So now we've got then, let me just check this one more time. We've got the checking account at the $109,980, down by $500 to $109,480. And then, of course, the telephone going up to that $500 on the GL.